Most people believe wealth is a direct function of hard work and higher income. You study, earn a professional degree, secure a good job, and climb a career ladder. On paper, it makes perfect sense. You work more, you earn more, and you save what's left. Yet the numbers prove something entirely different. Income growth rarely translates into wealth growth. Let's look at the average U.S. household earning $120,000 per year. After federal and state taxes, Social Security, Medicare, and typical living expenses, the remaining disposable income is roughly $25,000 to $30,000. That's just 20 to 25% of gross income. Even if you save that full amount, which almost no one does, and invest at 5% annually, you'd accumulate around $500,000 after 15 years. That sounds decent until you realize that inflation cuts purchasing power by about 1/3 over that same period. Meanwhile, housing, healthcare, and education costs rise faster than your returns. Now compare this with an upper-class household reporting less income on paper, say $80,000, but controlling $2 million in income-producing assets through LLCs, trusts, or partnerships. Those assets generate dividends, depreciation write-offs, capital gains, and deductible expenses that drastically reduce taxable exposure. This family legally pays a lower effective tax rate than the middle-class professional who works 60 hours a week. Their wealth compounds through retained capital, not earned wages. This is the quiet problem the financial system never highlights. The average person is trained to think in terms of income, while the upper class thinks in terms of structure. You're told to maximize earnings. They're told to minimize exposure. And that difference changes everything. Most people think they're doing everything right. Saving in a 401k, paying down mortgage principal, contributing to an index fund. These are all responsible actions, but structurally inefficient. Why? Because every dollar you earn is fully taxed before you get to invest it, while asset-based earners invest before taxation occurs. When you spend decades building wealth post-tax, compounding works dramatically slower. To put it simply, the system rewards owners, not earners. The tax code doesn't hide this. It's built on the assumption that ownership grows the economy. Labor income is taxed up to 37%. Long-term capital gains? Around 15 to 20%. Depreciation and expense deductions? Immediate reduction in taxable base. The wealth gap exists not because of income inequality alone, but because of how that income is categorized. The uncomfortable truth is that most people are on a treadmill, constantly earning more but never escaping taxation and consumption cycles. Every raise triggers higher withholding, every purchase increases fixed costs, and every investment is built on after-tax crumbs. Over 30 years of doing everything right, the median professional retires with less than $400,000 in assets outside home equity. Structurally, that's insufficient. Not because they failed to work hard, but because they played the wrong game by the right rules. This is the foundation of the upper-class cheat code. It's not about luck or insider trading. It's about understanding that wealth isn't made by earning. It's made by how income is processed and retained. Most people never question why the tax code favors certain flows. They just keep working harder inside the same framework. Before we get to the solution, it's necessary to understand why the system rewards some behaviors and penalizes others. Because once you see that, the mechanics of wealth creation stop looking mysterious and start looking deliberate. To understand why this problem exists, we need to look at how different income structures operate. Most people live entirely on earned income, money exchanged directly for time and labor. It arrives as a salary or wage, fully visible to tax authorities and fully taxable the moment it's paid. There's no deduction for your time, no offset for effort, and no way to defer taxes until later. You work, you get paid, you get taxed. Now, compare this with how the upper class structures their income. They don't rely solely on labor. They own or control entities that earn on their behalf. When income passes through an LLC, S corporation, or holding company, it can be classified differently, as dividends, distributions, or capital growth. Each of those categories is taxed at lower rates or deferred entirely if reinvested. The same dollar, flowing through a different structure, is treated far more efficiently. Let's take a real-world comparison. Example 1. Sarah is a senior engineer earning $150,000 per year in salary. After taxes and deductions, she takes home around $100,000. She saves 10% or $10,000 per year in her 401k. After 20 years with 5% average returns, she might have about $330,000 in today's dollars, all of which remains taxable upon withdrawal. Example 2. David runs a small consulting business generating the same $150,000 in annual profit. But instead of receiving it as salary, he takes a modest $70,000 as personal income and leaves $80,000 inside his LLC. That retained income can be reinvested before tax in growth assets or used to purchase deductible items such as equipment, business travel, or even partial real estate ownership under the company structure. Over 20 years, his reinvested pre-tax capital compounds faster than Sarah's post-tax savings, often more than doubling the effective wealth creation under similar conditions. What makes this possible isn't intelligence, luck, or unfair advantage. It's structure. The financial system rewards capital formation over consumption because capital stimulates the economy. By design, business and investment income receive preferential treatment to encourage reinvestment. The middle class, trained around the security of hourly wages and salaries, never enters that system. It's behavioral, not educational, inertia. This is also why generic financial advice fails. You've heard it before. Spend less than you earn, save consistently, invest long-term. These are safe guidelines, but they don't address the underlying inefficiency of how income flows. Saving 10% of your post-tax income in a retirement account can't match someone reinvesting 50% of pre-tax corporate cash flow into appreciating assets. Even if the rates of return are identical, the timing and tax treatment make the results incomparable. Another subtle cause is the lack of a financial operating system. Most middle earners operate linearly. Earn to spend, to save, to invest leftovers. The wealthy operate cyclically. Generate to allocate, to defer, to compound. One extracts value after production. The other compounds value before extraction. That single shift multiplies long-term outcomes geometrically. This systemic difference explains why standard advice, even when applied perfectly, often leads to mediocrity. It teaches isolated habits, not integrated systems. Real wealth isn't just about saving or budgeting. It's about directing the flow of capital through protective structures so it grows before the IRS takes its share. Until income is restructured, effort alone can't overcome the drag of taxation, inflation, and linear growth. What we call the upper-class cheat code is simply the wealth system as it was meant to be used. by those who learn to play in the right category of income. The real challenge isn't to work harder, it's to restructure how money moves through your hands. The majority makes three structural mistakes that compound silently over decades. First, treating all income as personal salary instead of routing it through ownership entities. Second, confusing liabilities with assets, buying cars, vacations, and upgrades on earned income while calling them rewards. Third, saving post-tax dollars instead of creating pre-tax reinvestment vehicles. These aren't character flaws, they're systemic choices that erode wealth. Let's quantify the long-term consequences using simple projections. Assume two people start at age 35 with identical $100,000 annual gross income and 3% annual raises. Both save 15% of what's left after taxes and expenses. Scenario A. Typical middle-class path, salary focus. Year 5. $18,000 annual savings after 32% effective tax rate to $100,000 total at 5% return. Year 10. $21,000 annual savings to $280,000 total. Year 20. $30,000 annual savings to $850,000 total, inflation adjusted, approximately $500,000. Retirement reliance. 80% on Social Security and pension. Scenario B. Structured ownership path. Same income, restructured. Year 5. $30,000 reinvested pre-tax via LLC to $180,000 total. Year 10. $45,000 annual reinvestment to $650,000 total. Year 20. $65,000 annual reinvestment to $2.8 million total. Inflation adjusted, approximately $1.6 million. Retirement reliance. 10% external sources. The gap isn't from earning more. Scenario B generates the same raw income, but retains 2.5 times more capital through lower effective taxation and faster compounding. Over 20 years, the structured path creates $1.1 million more wealth on identical effort. Mistake number 1, compounds through opportunity cost. Personal salary caps your reinvestment at 68% of gross, after taxes. Ownership allows 80 to 90% retention by deferring taxes and claiming deductions. After 10 years, that's $300,000 less capital working for you. By year 20, it's $1.5 million. Mistake number 2 destroys velocity. When you spend $20,000 on a new car financed at 5%, you've locked yourself into $4,000 annual payments. Money that could have been deployed into a rental property generating $6,000 net cash flow. Over 20 years, that single decision costs $150,000 in lost compound growth. Multiply by 3 such purchases, and you've surrendered $450,000 of potential wealth. Mistake number 3 is the deadliest. Post-tax savings at 5% net return compete with inflation and withdrawals. Pre-tax business reinvestment at the same gross rate yields 7 to 8% effective after deductions. The math difference over 20 years turns $1 million in contributions into $2.5 million versus $1 million. Notice the key insight. These outcomes don't depend on income level. A $60,000 earner who structures correctly outperforms a $200,000 salary earner who doesn't. The problem isn't what you earn, it's how you process it. Taxation and consumption act as gravity, pulling wealth back to zero unless countered by ownership leverage. After 5 years, the difference feels minor. $80,000 versus $150,000. By 10 years, it's $250,000 versus $600,000. Enough to notice, but not panic. By 20 years, it's $800,000 versus $2.8 million. Enough to live differently or struggle. Most never see it coming because the drag is gradual. But once exposed, the solution becomes obvious. Restructure the flow before it's too late. The solution is a three-step system to restructure income flow from personal labor to business ownership. Form a legal entity, route income through it, and reinvest pre-tax capital into income-producing assets. This shifts you from the high-tax labor category to the lower-tax ownership category using existing tax code provisions. It's accessible to anyone earning over $50,000 annually, requires no advanced finance knowledge, and scales with effort. Step 1. Form a simple ownership entity. Start with a single-member LLC, which is a legal business structure you fully control. Costs $100 to $500 to register, depending on your state, plus $50 to $300 annual fees. Once formed, open a separate business bank account. Instead of receiving all freelance, consulting, or side income directly into your personal account, deposit it into the LLC first. This classifies the money as business revenue, not personal salary. You pay yourself a reasonable salary, say 40 to 60% of profits, which is taxed normally. The rest stays in the business for reinvestment. Step 2. Deduct and reinvest before personal taxation. Businesses can subtract legitimate expenses from revenue before any personal tax applies. Common deductions include home office space, prorated portion of rent/utilities, equipment, laptops, software, marketing, professional fees, and mileage. For example, if your LLC generates $10,000 monthly revenue and you deduct $3,000 in verified expenses, only $7,000 counts as taxable profit. Pay yourself $4,000 as salary, taxed at your personal rate, and retain $3,000 inside the LLC. That retained amount buys assets like domain names for online content, inventory for resale, or even a down payment on rental property titled to the business. These purchases often qualify for immediate deductions or depreciation, spreading tax benefits over years. Step 3. Acquire assets that generate passive cash flow. Use retained business funds to buy appreciating assets, rental real estate, dividend stocks via a brokerage account in the LLC's name, or digital products like online courses. The logic is simple cause and effect. Assets produce income independent of your time, and that income flows through the same low-tax business structure. A $20,000 rental down payment at 8% annual yield generates $1,600 cash flow yearly, most of which is sheltered by depreciation deductions. Over time, rents rise with inflation, while mortgage principal reduces automatically. This system is stable, not risky, because it leverages built-in tax code incentives for business formation, provisions unchanged for decades. LLCs shield personal assets from business liabilities if operated correctly. No commingling funds. Returns come from proven asset classes. Real estate has averaged 10.6% annual total return since 1970, far outpacing inflation. No speculation involved. Just consistent allocation of 20 to 40% of gross revenue into ownership. Effective tax rate drops from 25 to 35% on salary to 15 to 22% on business distributions, proven across millions of small entities. The mechanics compound reliably. Year 1 reinvests $20,000. Year 3, leveraged assets produce $5,000 extra. Year 5, Total sheltered capital exceeds $100,000. Risk is minimized by starting small. Test with $1,000 monthly side income and consulting free IRS resources or a $200 per hour CPA for setup. This isn't evasion. It's optimization within public rules. Anyone can implement it in 30 days. Register the entity, redirect one income stream, track deductions monthly. The result is capital working for you at higher velocity, creating a self-reinforcing cycle of growth. This 5-part system integrates everything into a single, repeatable process. Restructure income through ownership. Deduct before taxing. Reinvest into assets. And compound the cycle. Start with one income stream, freelance, side hustle, or 20% of salary via consulting, and route it exclusively through your LLC. Track every business expense monthly. Allocate 40% to personal draw, 30% to deductions, 30% to asset purchases. Review quarterly. Adjust deductions upward. Scale assets based on cash flow. This creates a closed loop where business growth funds more business growth, independent of job security or raises. Here's what changes over time with consistent execution on $100,000 annual income. Year 1. Foundation. Form LLC, $300 cost. Redirect $20,000 side income. Deduct $6,000 expenses. Reinvest $8,000 into starter assets, for example, dividend ETF or digital product. Tax savings, $2,000 to $3,000. Net position, $25,000 sheltered capital plus basic entity running. Lifestyle unchanged, but 20% more cash flow retained. Year 5. Momentum. Assets grow to $150,000 through reinvestment and 7% average returns. Annual sheltered cash flow, $12,000. Deductions scale to $25,000 per year via equipment, marketing, partial real estate. Effective tax rate drops to 18%. Total wealth outside personal accounts, $200,000. Job income now supplements business income. Reversal begins. Year 10. Autonomy. Assets reach $650,000. Passive income covers 70% of living expenses, $45,000 per year. Business generates $80,000 pre-tax profit annually. Deductions exceed $40,000. Personal salary optional. Total net worth, $900,000 inflation adjusted. You control withdrawal timing, deferring taxes indefinitely on reinvested portions. These projections use conservative math. 7% blended return, 4% dividends plus 3% appreciation, 3% inflation, no market crashes assumed. The system self-corrects. Downturns trigger more deductions. Upturns accelerate compounding. Immediate action steps. Start today. 1. Check your state LLC filing requirements. Online, 15 minutes. Budget $500 max. 2. Identify one income source. Freelance gig, content sales, or consulting equivalent. Minimum $1,000 per month viable. 3. Register LLC this week. Open business bank/brokerage accounts, free at most banks. 4. Redirect first payment next month. Log expenses in spreadsheet. Office, 10% home space. Mileage, IRS rate 67 cents per mile. Software, $50 per month. 5. Consult CPA for $200 to $300 setup review. Confirm Schedule C filing. Track first quarter. Adjust. 6. Month 3. Buy first asset. $2,000 minimum. ETF or rental deposit. Repeat monthly. Execution takes 4 hours per week initially, drops to 1 hour. Scale as comfort builds. No complex software needed. Excel suffices. Real wealth builds through deliberate structure, not higher earnings alone. This system uses tax code provisions available to anyone since 1970s reforms. Applied consistently, it shifts you from taxpayer to capital owner over a decade. The results compound predictably because they're rooted in arithmetic, not speculation. Start the process, and the structure handles the rest.